Hey guys, welcome back to another episode of Market Champions. Today we've got Luke Gromen, the founder of Forest for the Trees LLC, a research firm. So thank you so much for being on the podcast.
Thanks for having me on. It's great to be here.
Could you give the audience a little bit about your background and how you got into finance and your journey to Wall Street and how you got to where you are today?
Absolutely. So I actually went to college to be an architect and went to the University of Cincinnati, which has one of the top 5 architecture schools in the country, and started there, got about a quarter and a half into my first year of architecture and realized I didn't want to be an architect for the rest of my life. So I switched majors to finance and accounting, which was something that had started to interest me, and got my degree there. Cincinnati had a co-op program where I would go to school for a quarter and then work a quarter with a corporation or company. And my first co-op program was with an investment research firm out of Cleveland, a boutique firm called Ralston and Company, and worked with them for about a quarter and a half. And then a group of partners split from there to form a company called Midwest Research in 1996, about halfway through my second co-op term. Went with them as literally the guy sitting on the temporary office space floor, licking envelopes and sending out mailers to prospective clients to let them know that these partners we're starting a new firm. Fast forward a year and a half, they hired me out of college to be work junior sales position, and began calling on accounts about a year and a half later. And they made me a partner about a year and a half after that, based on how well things were going. We sold that firm to Midwest Research. We sold that firm to First Tennessee Bank in 2001. Worked with FTN Midwest for about 6 years after that firm was sold. And then in 2006, myself and about 20 other partners formed Cleveland Research Company, which was both Midwest and Cleveland were deep in the weeds, bottom-up fundamental research. So both research and sales, and basically focusing on retail, consumer, industrial, technology, healthcare stocks, and selling that research to a variety of different institutional research or institutional money managers around the world. And going into 2008, I had long been one of the editors of a weekly summary piece that both married what we were doing from a deep bottoms-up standpoint and top-down macro thematic type work reading I was doing on my own.
Right.
And so I was doing more and more of that, wanted to do more of it, focus more on the macro. Went to my partners in 2013, said, I'd love to do macro full time. They said, we'd love to have you. I said, my one caveat is I want to have complete creative control to write whatever I want to write, because I felt like that was going to be important for what seemed possibly to be developing. And so we parted ways amicably. I hung up my own shingle as FFTT in early 2014, and we're coming up on our 7th year, and
Awesome.
it's been a great ride. It's been a lot of fun.
What's the story behind the name FFTT? It's sort of extremely unique. You know, it's sort of not like it doesn't have a rock or a stone or something like that in the name.
You know, I had a lot of clients and friends say I always had an ability to just put big pieces, put the pieces together well. I was very good at connecting dots. And others say there's, you know, the phrase, hey, you're missing the forest for the trees. And so I just thought it was a neat play on words of a neat metaphor anyway. And, you know, the FFTT is unique in terms of just being memorable in terms of branding. I thought it would be, and I think it has been. So that's really, it's just a nod to what we try to do, which is really help our clients see the forest for the trees.
Got it. So I wanted to start off the interview with probably the most obvious question. We're seeing the DXY start to hit new lows. So is this the beginning of the Luke Gromen moment? So what's going on?
You know, so we've seen the dollar fall pretty sharply, really ever since March. I think, is it the beginning of the Luke Gromen moment, so to speak? I think two things happened earlier this year that I think were really important as it relates to how a lot of investors perceived the dollar, perceived the Fed, perceived markets overall. And those two things were, number one, how much the Fed was willing to grow their balance sheet by in a short period of time. And number two, what they were willing to do to change regulations for the banks as it relates to U.S. Treasuries. And so with those two things, I'll break them down one at a time. With the Fed's move, they're going into March, I think there was a belief that the Fed could not do enough to stop the dollar from rising. And in a, call it 2-month span, for a 2-month span, they grew their balance sheet at a $20 to $35 trillion annual rate, which is, call it 100 to 200% of US GDP in a short period of time. And it stopped the dollar from rising. And the liquidity crunch that was driving the dollar higher went away. The Fed was able to handle it. And so I think there was a very much a realization, or those that were saying the Fed could not do enough were forced to revisit that thesis. You know, we had been thinking the Fed could, and when push came to shove, would do enough. And so that was, I think, number one, what happened with the dollar. Number two, and I still think this does not get as much press as it should. I think it's getting more press now, but back in early April, the Fed changed leverage. So Basel III, or the banking regulations set by BIS, and I don't know, it's 100 countries, something like that, abide by them. At any rate, there's something called supplementary leverage ratios, or SLRs. Basically, what it tells you is the banks, if they have X dollars of assets, they need to have some percentage of X in capital backing those assets. And what was happening throughout late 2018, all throughout 2019, was that U.S. debt was growing, U.S. Treasury bond issuance was growing, and there wasn't enough demand for that issuance outside of the U.S. banking system. And so the U.S. government was basically crowding out the U.S.'s own banking system. And that came to a head in the repo rate spike of fall 2019, but then really came to a head in March of this year with the COVID crisis. And so the Fed in April of this year suspended temporarily the SLR regulations only as it relates to treasuries, which basically was the Fed waving a wand and saying the banks can conduct QE forever for us. And for a long time, that was not paid that much attention to. We were highlighting it pretty vocally for our clients in April and May and June. I think it's gotten a lot more airplay since. So when you say, is it the Gromen moment on the dollar? I think really, I think it started. I think the point of the game where the Fed has to continually be involved in the treasury market because of U.S. deficits growing and because of a lack of foreign demand. I think that's begun. And I think when we see things like Fed Vice Chair Quarles last month, it's December, 2 months ago, at the end of October, he said we may need to be involved in the treasury market for the foreseeable future anytime there's stress. That, I think, is a very big validation in terms of our viewpoint, which was push when it came to shove. The Fed could do enough, would do enough, would change the rules if they had to, and then would probably have to be involved in the treasury market in a much more structural way. And it probably wouldn't be good for the dollar. And so those four things really have begun playing out. So I don't know if it's all the way there yet, but I think we've got a lot of momentum in that direction, we'll say.
And then, one of the things you've talked about is, central banks, foreign central banks are actually selling treasuries. So, there's the case that foreign central banks are selling these treasuries in order to sort of fund a US dollar shortage. Is that true? And why or why not?
I think it is true. I think so we've always highlighted the third quarter of 2014 was a huge moment because that was when foreign central banks stopped growing their holdings of treasuries on a net basis for the first time in 70 years. So nobody alive trading had ever seen a market in which this big fundamental change had happened. There's really a couple different reasons why that was happening. I think there were geopolitical reasons. Some of it was the U.S. sanctioning people. Some of it was people or nations saying we don't want to buy this anymore because of geopolitical reasons. But I think the biggest part was, at least initially, was ultimately exactly what you just highlighted, which is they have a dollar shortage, which is to say the dollar's too strong. And so when you look at, there's a couple different factors that can drive that, but ultimately if they're short dollars, they have to sell treasuries or other dollar denominated assets to raise the dollars to pay that back. And so what it speaks to is this fundamental mismatch, and a fundamental that the dollar is basically too strong, and they will keep selling dollar assets until they don't need to anymore, until either the dollar shortage is resolved or they're out of dollars to sell, in which case they have a currency crisis, et cetera. So that's the balance. Something that's very different this time is when you look at the U.S.'s net international investment position, or NIIP, historically, if we go back to 1998, that emerging market crisis, I want to say the U.S.'s NIIP was negative 3% of GDP. So when these foreign countries start selling down dollar assets, it doesn't take too long till they're out of dollar assets and they have a currency crisis. They have to adjust their currency sharply lower, which is what we saw in Southeast Asia in the late 1990s. If we go to 2008, the US NIIP was negative 8 or 10% going into that crisis. So bigger, but still, they could run out of dollar assets. That number is now negative 60%, 60%. And so what that says is they can sell a lot of assets, and they're not going to run out of dollar assets to sell anytime soon.
Wouldn't selling dollar assets, wouldn't that just push up the price of the dollar as we saw in March? In March.
It's exactly what it does. Is it creates basically a death spiral where the dollar goes up and dollar assets go down and down and down. And left uninterrupted, the way this used to work was they run out of dollar assets to sell, and then they have to devalue their currencies massively. And then U.S. comes around with the strong dollars and goes and buys up all their assets on the cheap, and we start the whole game over. What happened this time is they own so many more dollar assets because our deficits have been so big and the imbalance has been grown for so long that they weren't going to run out of dollar assets. What was going to happen is the U.S. stock market was going to go to zero. or close to it, basically. And the really big one, the super huge one, the one that forced the Fed to react, and the one that we thought would probably be the reason the Fed would react, was they broke the Treasury market. Treasury, the deepest, most liquid market in the world. You go to March 9th through March 18th, and all of a sudden, stock market's crashing, and the Treasury market's crashing right alongside it. Yields are rising sharply as the U.S. stocks are falling. And in my career, 25 years, that had never happened. I look back, I don't think it ever happened in the 15, 20 years before I started in this business. And so that was really the problem. I think that ultimately forced the Fed's hand. And what that tells us is the framework that everyone was using going into this, or virtually everyone was using going into this, was U.S. is at the center. They will break last. The emerging markets will break first. And the emerging markets did break first, particularly the weakest of the weak, when right. Turkey, Argentina, Venezuela. However, the others ended up, they were under pressure, but then they were under so much pressure, they broke the Treasury market. And that was a very, very different outcome. And that has then forced the Fed's hand. It's forced the dollar response. And so I think it really does tie back to this point that I think sort of that moment has begun.
So isn't the whole thing psychological, since the Federal Reserve can only sort of swap bank reserves for treasuries? So in a sense, it's simply people believing that they're actually printing dollars, that's actually pushing the dollars down. So, when people realize that they're actually just doing a reserve swap and not actual money printing, because the Fed can't define what money is. Even Alan Greenspan admitted that in the 1990s, and that's why they switched to Fed funds targeting, so say money supply or money demand targeting. So wouldn't that be true?
Yes and no. in my view. So ultimately, I would say they are just doing an asset swap. That's the yes portion of it. With that said, they are injecting dollar liquidity. They are effectively printing dollars into the asset markets where you're seeing spreads tighten. You're seeing, it's blunt force liquidity.
But isn't that like psychological and not like actual fundamental change? Isn't that just people believing that, the Fed is going to backstop or, or the Fed is there, but even though the Fed is actually powerless in the situation?
I don't know if they're powerless or not. I would say that they're not. I mean, ultimately, if $35 trillion over a month, at an annual rate wouldn't have done it for 1 month, they'd have done it for 2. They'd have done it for 3. They'd have done it for 4. Ultimately, they can keep doing it. They can swap setting aside any type of legal or technicalities, just from a flows perspective. There's nothing that can prevent them or that would prevent them from literally printing the money and buying, doing an asset swap, every asset in the world, every asset in America for dollars. They could do that. Again, setting aside some of the technicalities. So it is psychological on some level. I mean, you could say they are significantly affecting velocity, the monetary velocity within asset markets. I think that's a fair way of putting it. But when there is a regulatory difference between, either a treasury or a corporate or a junk bond, and they are taking that asset off of someone's books and replacing it with cash, that does change the dynamic. There's a credit quality change to the balance sheet where they do that. So I would say on one level,
could you say that again?
Yeah. So when they do this asset swap where they are giving cash to somebody who owns, when they're buying a bond, some other asset off somebody else's books, swapping that out, there are regulatory differences between cash and even treasuries, less so after April, but certainly before. But there are very much regulatory differences between cash and corporates, cash and junk, cash and equities, whatever you. And so while it is just an asset swap, there's an important qualitative regulatory dynamic to that asset swap that is, I think, more than just psychological. They now have cash that they can relever. They're liquid. They don't have to haircut. So I do think there is more than just a psychological impact. Although I would agree there is a psychological impact.
Yeah, one of the things that people usually argue is they say, look at Japan, they've done 24 QEs and sort of 24 stimulus packages, and shouldn't we be seeing 1970s type of inflation there? But one of the things you tweeted, I believe earlier this week, is you said that, and I quote, "I remain surprised that more people don't see the fact that the Nikkei is still below the 1989 level, while the Nasdaq is 2.5 times the peak 2000 level, as a warning that the US economic outcome is also likely to be quite different than Japan." So could you go more into what that meant?
Sure.
How sort of that implies a difference in the outcome, and and how the outcome is going to be different?
Sure. I think, I hear a lot, hey, Japan's done it, and so it's not a problem. Now I've only seen one person, I think the gentleman's name, Hirschman Capital. He did a study showing that once you went over 100%, I think it's over 100% debt to GDP, it's happened 52 times over the last, 120 years. 51 of those times, you've had significant inflation or hyperinflation. The one time you haven't, it's been Japan. And so it's interesting, right? You've got like this 95% confidence interval that it's going to happen. And everyone cites Japan as being it. Now, there are puts and takes, but why I think we are more likely to have an outcome of, call it, Argentina with US characteristics, is because of the differences between the United States and Japan. So if we look at Japan, Japan started the experience with very low debt to GDP, the US starting it with high debt to GDP. If you look at Japan, they were a significant and remain a significant current account creditor nation. In other words, they consistently have more foreign currency coming in than going out every year. The United States is a significant twin deficit nation. In other words, we consistently have more currency going out than coming in. The Japanese were and remain primarily funded internally, and their own people buy their debt. We have historically primarily been, or at least significantly been, externally funded, which means we're dependent on the kindness of strangers and or strangers we have a gun pointed at. The Japanese have a net international investment position of positive 50% of GDP. So in a pinch, they can sell assets up to 50% of their GDP to bring back and support their currency. We have the negative net international position of international investment position of negative 60% of GDP. So we're on the hook. We have capital here already that could leave. And so there's all of these differences basically mean that we are going to have to emit larger and larger amounts. The central banks have to emit larger and larger amounts of dollars. Those dollars are going to have to go overseas. And basically the flows are 180 degrees different. Now, the other thing that's really different, two things really. Number one, we've effectively provided Japan's defense for them. So they have been in no small part a creditor relationship or a almost like a territorial relationship with the United States, right? We have lots of military bases, important military bases in Japan. And that changes things. We have to provide for our own defense. So they haven't had to spend as much on defense as they might otherwise have done. And I think the big thing in our favor is that we've got the global reserve currency. And so that can be stretched very far, and we've been stretching it pretty far. And that gives us more leeway. And the Eurodollar system as it is, it creates this demand for dollars that, again, soaks up some of these things we're talking about in terms of these otherwise dollar outflows. So it's ultimately, because my view is because the dollar obligations that we have are so great, entitlements, defense, interest expense, and we do have the reserve currency, we will print them in my view. I don't think cutting that entitlements in particular is politically viable anymore. I think we're going to see a steady increase in the emission of dollars globally at a time where the world's need for those dollars for trade is shrinking on the margin, given some of what China and others are doing in terms of multi-currency commodity pricing, et cetera. And that at some point hits a tipping point and the dollar weakens. And that's where I think the big difference is, or some of the differences are between the US and Japan, why I think ultimately we're going to end up with a different scenario than the Japanese.
And the most interesting part of that was that 51 out of 52 QEs have led to inflation.
51 and 52, when you've been over 100% of GDP, they're resolved usually with inflation. Yeah.
Right. So where is like inflation in the US? Do you think like it's about to start? What is going to be the catalyst for inflation? Because, the banks aren't lending, and the commercial banks aren't actually lending to anyone except the government. And they're not willing to take risks other than, say, the U.S. government, which is sort of the safest creditor.
I think that's really that's where I think it will start, and where I think it'll come ultimately is I think the government is committed to spending by virtue of the entitlements, by virtue of defense, by virtue of interest expense, and the banks are lending very aggressively to the government. And also ultimately where I think it shows up is in what appears to me to be an increasing marriage of fiscal and monetary, so the Fed and Treasury acting much more closely together than they have really any time since the early 50s, in my view. And ultimately, I think that starts to reflect itself in the dollar. And once the dollar weakens enough, then when you're a country that is importing as much as we're importing, that should start to show up in the price of imported goods, CPI, and eventually that transfers through the wages. So, we've seen the dollar weaken, 5-6% this year. You're starting to actually see some of the inflation break-even data hitting the highest levels in 18 months. I don't want to get carried away with that, but it's interesting to me. But ultimately, U.S. government is, people say, well, they're only lending to the government. Well, U.S. government's the single biggest entity in the U.S. economy. They're 25% of GDP when you look at what the government spends. And so U.S. banking system is growing their loans to the single biggest entity in the U.S. economy at a 20% annual rate. So it doesn't take too many years in a row of that before it starts to show up more broadly in headline bank lending, and people say, wow, where'd this come from, when that happens or if that happens. But it's building just below the surface. So that to me is where I think it will come from. I think you're exactly right. It'll come through the government side.
And one of the other things you've talked about, due to sort of commercial banks buying U.S. debt, is it's sort of become a Chinafication of the U.S. So what are the implications? What are the sort of long-term implications of that?
Yeah,
Do we become China?
I think we're going to become the U.S. with Chinese characteristics. Earlier this year, the U.S. government came out with a white paper. It basically said we are now in a great power competition with China, and this delineated some of the terms of that great power competition. It really framed it in Cold War terms. And when you look at the Cold War, and again, this is sort of that forest for the trees view of just seeing the big picture, the Cold War was not going to be won or lost for lack of dollars. You basically had the fiscal side, the government side, the Pentagon spending whatever needed to be spent, and Treasury going along with that, and the Fed doing their role. And that ultimately ended up in high inflation in the 70s. And I think that's ultimately when your adversary, when your competitor, however you want to frame the relationship with China, you can't beat them unless you do some of the things they're doing in terms of this industrial policy. And there were numerous U.S. government and U.S. corporate leaders saying this for years. But I think in the last 18 to 24 months, it has really sunk in with U.S. leadership that we need to do this. And I think COVID was a big part of that, where we needed masks, we needed PPE for COVID. We couldn't get it. And that, I think, swung the remaining policymakers, leaders that were skeptical about the need to have some sort of manufacturing sufficiency. And so to me, that's where it will start to show up. One thing I'm looking for is for this industrial policy to really begin happening in a bigger way, where you get back to what we had in the aftermath of World War II, which the last time the U.S. debt was this high, the last time foreigners were not buying enough of our debt, the Fed kept yields at 2.5% for 10 years. And real interest rates were bottomed at -5 or -6, maybe even lower. They might have bottomed at -10. But the bottom line is there's this ongoing debate about, well, if real rates bottomed in August this year at -1.1%, and I don't think that that's likely. I think real rates in the United States are likely to get much more negative based on where the geopolitical seems to be leaning, which is, okay, we have this great power competition with China. We're going to start to see more centrally directed initiatives on the defense side, on the infrastructure side, on the Green New Deal side. And as that happens, there doesn't seem to be a lot of, I don't think anyone at the Fed's going to stand up and say, you know what, we need to worry about the dollar, right? Let's worry about the dollar here and let people die from COVID. There just is no appetite anywhere for this. So I think that's where this is going.
I'll get to the fiscal side more towards the end of the interview. I'm more curious about one thing. So over the last decade, we haven't really seen any high inflation, even though we had about 4 rounds of QE. So, well, number one, what went wrong there? And then the other thing is, in March, a lot of the primary dealers who wanted to do repo operations started sort of differentiating between on-the-run and off-the-run treasuries, which led to a massive repo rate spike. And at the moment, most of the primary dealers are very happy to buy these U.S. treasuries. So, and the treasury auctions also show good demand. So is there sort of a safe asset shortage? And why are banks so happy to buy these treasuries? If in your opinion, inflation's going higher and you expect insurance yields are going to go higher, are the banks wrong?
So I would say if you and I would have talked in 2008 or 2009, I would have thought, oh yeah, inflation's coming. And to be clear, from '09 to 2011, inflation was coming. If you look, the price of oil in early '09 was 35, and by mid second quarter of 2011, it was back to $110 a barrel. You look at some of the CPI metrics, it was picking up. Bigger picture, though, it was nowhere near probably what I would have thought it would have been had we talked in '08 or '09. And I think it really comes down to where the more I've read, I really have come to be a big believer in Professor Richard Werner's view, which is really delineating between lending into the productive economy or spending into the productive economy, the real economy, relative to the asset economy. And when you really look at what the Fed has done with QEs, it's largely been about the asset economy, bailing out banks, reliquefying banks, more than productive economy, real economy that would show up. So we've had high inflation in asset prices for 10, 12 years. We've not had high inflation in the on the real economy side. In terms of the banks, I think they're happy to buy them for a number of reasons. I think number one, it goes back to that SLR, the regulatory change. Number one, they need regulatorily, they need to have it. They count as capital, so they are regulated effectively into buying them. Number two, if I was a bank and the Fed gave me the deal that the Fed gave them in April, which is you can buy as many as you need to, and you're going to basically have no funding cost attached to that. So if I could buy a 10-year at basically zero, it doesn't really matter. As long as the rate's positive, I can buy as many as that's a good deal for me. Nominally, that's a good deal for me. And ultimately, I think that's all that matters for the banks in the short run. With that said, throughout my career, if you've wanted to find the next bubble, or if you wanted to find where the next area to avoid as an investor is, historically, a good way to find that is to go find what all the banks are doing really aggressively and do the opposite. In other words, you go to the late '90s and there were numerous banks paying up for tech investment banks at high multiples in 1998, '99.
That didn't how that ended, yeah.
Right, they're falling all over each other to make subprime housing lending. Didn't work out well. Well, what are they all doing now? They're falling all over each other to buy treasuries. They're buying treasuries at a massive clip. Now, that's not to say that they're going to lose, or that I think on a nominal rate. What I think is much more likely going to happen is that these treasuries are going to be turned into certificates of confiscation on a real basis over time, which is what happened the last time we were in this position, from 46 to call it 55, 54. And it sort of is what it is. I think ultimately when you look historically at emerging markets with balance of payments problems, one of the things they almost always do is the government comes down with regulations, strong-handed regulations, or they use the carrot and the stick approach where they change the regulations to make it sweet. But the bottom line is they regulate the domestic banking sector into buying more of the sovereign bond market, and that's exactly what's happening here. It's just we don't like to frame it that way because it's America, and we would never know. We would absolutely do that. It is what it is. Right. To me, that's where it is. So I think there's just this mismatch in perception of the or mismatch in timing. I think ultimately it makes perfect sense to their business model this year. They get paid to make money this year, this quarter. If inflation really got away, I don't know that they have to take mark-to-market losses, but ultimately that to me is where things really get going when you talk about the Gromen moment. And this is what we're heading to, but it's if inflation starts to get away, the Fed's going to have to cap yields. And when the Fed caps yields, then things get really interesting because, and this speaks to the difference between us and Japan, there's so much debt, the Fed's going to have so much of the dollar debt market put to them. Basically, once they start capping yields. So I think that's what I think I don't know that the banks are missing anything, but as you say, okay, well, why are the banks all doing this? Makes perfect sense. I'd be doing the same thing if I was a bank. But for the average investor, I think it's just a difference in timing.
How much control does the Fed actually have over the euro dollar market? So for example, let's say you have a bank in Singapore making a USD loan to a bank in the Cayman Islands. So how does the Fed have any effect on these transactions?
My understanding is that's very little direct. It's more blunt force.
In what sense?
If they, we saw that in March, for example, right? If they come in and say, we're going to buy $625 billion a week in treasuries, you can look at the EEM ETF since March. It is straight up and to the right. And that's an equity, those are equities. So those equities are responding to what's happening in the EM debt markets, et cetera. So if the Fed can't control that, but I think demonstrably, if they come in with just blunt force, with shock and awe, and do what they did, I think they've demonstrated the ability to basically road grade the thing. They can just flood with liquidity. They can't control where that liquidity goes. They can't control who gets it once it sort of gets away from them. But the spread, what you saw in spreads, what you saw in emerging markets, what you saw in all those things speaks to me. I think it's empirically, they can have an impact. They can't, they're not snipers. It's a B-52 strike. They are flattening everything with the liquidity, but they can have an effect.
Got it. I have a question. One of the things you've said is that the Fed will print sort of the mostest and the fastest. So, what exactly are they going to print when, number one, they can't define money? Do you think they're going to print cash? And the Fed really doesn't have any control over the money supply. It's usually the commercial banks that actually control the money supply. So now how exactly is that going to work? Do you think like Congress is going to give them the authority to implement, sort of print cash? And would the longer term implications of that be a more MMT style world?
To answer the last part, yeah, I do think it'll be a much more MMT style world. The way I envision it happening is really every central bank has to finance their own sovereign's deficits.
Right.
And if we look at and rank who has the biggest deficits in the world, it's not even close. America is absolutely number one. And it's really not close. And so that's when I say we have to print the mostest and the fastest. Once we hit that tipping point, that becomes the game. And that's not because we're bad or because we're particularly profligate. We are profligate in terms of spending, but that was the way that world worked from 71 to, I would say, 2014 was once we made the dollar the global reserve currency, and once we made the treasury the primary reserve asset of the world, we had to go into massive amounts of debt. This is basically Triffin's dilemma coming true. And so that's fine as long as others are financing us. The regulator on that whole system was that our deficits never got so big that didn't overwhelm the whole system. And the problem was once the deficits get so big that they overwhelm the whole system, some of which is due to demographics, because we made these promises for entitlements that were off balance sheet that are now coming on balance sheet as baby boomers get older. And some of it was bad policy. In 2000, when we were running a surplus, we decided it was a good idea to go, spend $6 trillion in the Middle East for, I don't know what we accomplished, quite frankly. We ran up debt, we spent a bunch of money. Some people won, some people lost, a lot of people died. And so both geopolitical policies, economic policies, the punchline is that we've now gotten past the point of no return where the deficits are overwhelming the system. The off-balance sheet stuff is coming on balance sheet. And there's just, once foreigners stop buying enough of it, one of two things happens. Either the Fed prints the money and buys it,
The dollar spikes.
or exactly, the dollar gets hit, or we finance it internally, and to finance it internally, we don't have the balance sheet for it either. A yield spike or the dollar falls. And if yields spike when your government owes 130% debt to GDP, you're done.
And that's sort of like the fundamental difference between sort of you and the milkshake theorists, because your view is that the Fed is going to print it, and their view is that the Fed is not, and that's sort of like the fundamental barrier between your view and sort of the milkshake theorist view. And I'm curious, now you said that the USD could possibly lose its status as the world reserve currency. So what would replace the USD as a reserve currency? Now, I'm not sure. I don't think we're going to see another gold standard, because I don't think there's enough gold to fund all the dollars in the world. So what do you think?
I don't think anything's going to replace the dollar. I do think it's going to lose its reserve status as structured post 1971. I think and again, it's pre-71, 46 to 71, the dollar was the reserve currency, but gold was the primary reserve asset. Post 71, to call it 3Q14, the dollar is global reserve currency and the treasury is primary reserve asset. And that basically let us run deficits without tears for the better part of 40 years. And I think where we're going next is you're going to have numerous regional reserve currencies. I think that will be or is being enforced by oil being priced in dollars, in euro, in yuan in particular. There's noise that the Japanese are looking at buying oil in yen as well. And then you need to settle those imbalances in some neutral asset. And to me, gold is it. Now, I don't think we're going back to a gold standard where anyone's going to fix the price of gold. I think what will ultimately be fixed might be the number of barrels of oil it takes to buy an ounce of gold. So if you revalue gold 500 barrels an ounce, then for energy transactions, you can sort of settle out that way, because when you really look at much of the world, most of the imbalances as it relates in particular, you look at Eurasia, Europe, China, Japan, most of the imbalances are around oil, energy, and commodities. And so if you do something around that, you can fix that part of the world. And then you've got, the Americans who are massive deficits because of the old system. So we can look at what central banks have been doing for the last 6-7 years. They've been buying gold. They've not been buying treasuries. To your point, for that to happen, the price of gold probably would need to be a multiple higher than it is today. And that's part of the reason why I like gold. I think ultimately that's going to happen. And I think it's a political decision. It could happen next week. It could happen in 10 years. I don't know. But that's a big part of the reason why I like gold as much as I do. So the answer is to my view, you're basically going to go back to what John Maynard Keynes advocated at Bretton Woods, which is you've got different reserve currencies, and you settle in a bank or in a neutral reserve asset to prevent the buildup of imbalances.
Got it. I'm going to title this interview, Luke Gromen says gold going to 50,000.
Do not. Do not.
I'm just kidding. To wrap up the interview, I wanted to ask you, we've seen an increased amount of government intervention all across the G7, and sort of these Marxist and socialist ideas are starting to gain relevance in the West again, and we can count on government to spend as much as required. So what sort of is the relevance of these ideas today, and what are the long-term implications of this?
It's a great question. The challenge for me, and I tweeted about this last week. I actually got a lot of good feedback on it, but it was the problem with with suspending capitalism for the banks and the politically connected in a democracy is that eventually the voters want you to suspend capitalism for them as well. And I think that's exactly what we're watching. And I try not to opine on one political system over another. I'm just trying to watch it. and see what's happening and where things might go. I ultimately think what we're witnessing today is the down payment on the true cost of how the 2008 bailouts were handled from a political standpoint. And what I mean by that is the Fed, the government, the G7 governments had to do what they did to prevent the system from collapsing chaotically. It was in nobody's interest for ATMs to stop working, banks to collapse, trade to stop flowing. You're talking about just an economic Armageddon, followed by a social and political Armageddon. It's in nobody's interest. So you had to stabilize the system. I understand that. That makes sense. However, from a political standpoint, what then had to happen was there had to be political costs to the major parties. In other words, when you go back to the 1929 crash, you find something called the Peckera Commission, and they review what happened, and they drag the Wall Street guys in, and they say, okay, you did this, did that. And from that, we had the Glass-Steagall Act, which shrank the banks, and the SEC Act. All these things happened, and it prevented, when you look from 1933 through 2000,
right,
crises were not that bad because everything was all directly tied back to 1929 in the response. Now you fast forward to what happened in 2008, and Wall Street went, broadly speaking, and to be clear, 9 out of 10 guys in Wall Street, they're great people. They're smart people. They're good people. They go home. They go play with their kid. Like, they're good people. Like, so this is not one of these the banksters. There's some out, but at a high level, there was malfeasance. There was a lot of malfeasance. And that malfeasance, somebody had to go in the volcano because of that, so to speak. There had to be the sacrificial lamb, and there wasn't. There wasn't. And even more interestingly is basically as soon as the immediate pressing moment was over, they sort of went back on everything. They've already been working on sort of getting rid of some of the, and in today's world, one of the great things and one of the hopeful things about today's world is to me, the internet is like Gutenberg's printing press in terms of the democratization of information. You want to find out about something, you can find, you could get done talking to me and get online and go take like all of MIT's freshman course load right now. And so people could get online and do their own homework about what happened. And that was really, I think people, as they dug into what happened, they realized, look, there was an element of this. So this was just a street hustle. There was some wholesale fraud that went unpunished. And so the problem is now, because it was just straight bailout, because we did socialism for Wall Street, how do you say no to socialism for mom and pop? No to socialism for entitlements? No to socialism for... It's very, very difficult to say, well, no, you can't, because they just benefited from that exact same socialism. And so it's, when you take a step back, again, it's these mega trends. It's not anything that's going to show up in CPI next week or the week after, but this big trend of how 08 was dealt with is going to be inflationary, because now politically there's no ability to not spend this money, to not have the government, and you're seeing that move politically. And to me, that's probably, as I look at it from as an economic and a socioeconomic standpoint, maybe one of the biggest lessons I'm watching, some of the increasing acceptance amongst both existing politicians, the younger generations, of much more socialistic policies. They're inflationary. There's no question they're inflationary, whether it's debt forgiveness for student loans, whether it's healthcare for all, whether it's universal basic income. None of these things are things that make you say, gosh, I want to go own a bunch of bonds at 80 basis points for 10 years.
Right. Thank you for being on the podcast. Oh, okay. My bad.
Yeah. So.
Yeah. Thank you so much for being on the podcast.
You're welcome. Thanks for having me on, and best of luck to you in the future.